A decline is inevitable, so being ready for the next market crash is important for all investors. On average, a crash occurs about once every decade, but it's impossible to predict when the next one will arrive. Taking the proper steps ahead of time will protect your investments and your finances so you don't end up losing your home like people often do when financial disaster strikes. By not being prepared, losing everything is a real possibility. That sounds extreme, but in the Great Recession, this happened to many families. After 10 or so years of a rising stock market, it's easy to forget the bad times and slowly become more and more ill-prepared for a repeat. Take the proper steps to prepare yourself for the future, so you can not only sleep soundly but have huge potential when opportunity presents itself. Stay to hear number 1, which is perhaps the most important thing you can do to be prepared. Number 7, pay down margin. Margin refers to the amount of equity an investor has in their brokerage account. Buying on margin means to use money borrowed from a broker to purchase securities. For example, an investor buys $100,000 worth of stock with cash, and then buys an additional $50,000 on margin. The investor will make interest payments of 5% or more and hopes to earn much more than that. The problem is that if the stock price declines, they're still on the hook for the loan, and they might be required to sell the stock at a low price to pay back their debt. This is risky behavior, and many investors would never even consider it. A lot of successful investors recommend steering clear of margin at all times, but just a few months ago, margin debt reached an all-time high. Margin debt can seem great when you're making excellent returns in a bull market, but it's easy to forget how quick things can get ugly. Number 6, diversify. Long into a bull market, a portfolio might be out of balance and overly concentrated in certain holdings due to ill performance. In other words, some holdings might have grown rapidly, making them a dangerously large percentage of your portfolio. If you purchased Tesla stock years ago and it was 5% of your portfolio at the time and it's outpaced your other holdings, it's possible those Tesla shares are now 50% of your portfolio. That portfolio composition is very risky and doesn't prepare you for the future. Keep in mind that the biggest gainers are often the biggest losers when the markets are red. If you're heavily exposed to certain industries, sectors, or individual companies, now is the time to scale them back and make sure you're well balanced. If the market were to crash tomorrow, would you be happy with your holdings as they are? Number 5, create multiple income streams. Having various sources of income is beneficial at all times, but even more so during a market crash. The main reason for this is that spending tightens and jobs are eliminated when the economy is in the dumpster. Creating multiple income streams allows an individual to have various cash flow sources that are coming in. This puts you in a better position to be prepared if one source of income fails, like it did for many when they were laid off in previous recessions. Relying on one single income source from a job is incredibly risky. Instead, try to maintain diversified income streams, whether in the form of businesses, investments, or even other jobs. The added security will prepare you for the unfortunate and can be used to invest or spend on recreation. Thankfully, there are many ways to make extra money so you can have several paychecks. Number 4, don't obsess over the market. Worrying about what the market is going to do every day is not good for your mental health or your finances. Instead, you want to focus on the big picture and what's likely to happen in the long term. Things might be red this month, but will they still be red next year at this time? So far, the market has always recovered its losses and continued to go higher, rewarding those who weren't alarmed about every little move. If you're worried about a market crash, it's probably best to keep investing regularly, even as stocks reach all-time highs. As Peter Lynch put it, more people have lost money waiting for corrections and anticipating corrections than in actual corrections. At any point in the past, there have been people worrying about a market crash and stopping their investing, and most of those times, they'd be wrong for doing so. Number 3, understand a decline is inevitable. Investing in the stock market with the expectation of always making a profit and never seeing any losses is unreasonable, and that mindset is setting you up for failure. After a decade of gains in the market, people assume the stock market is a place where asset values only increase. In reality, it's sensible to expect a 20 to 30% decline in prices at any time. That might seem like a lot, and that's because it is. Consider how much money you've made and are likely to make when you're invested over a significant period of time. When you're doubling your portfolio value an average of every 7 years with an S&P 500 fund, a small decline from time to time isn't a big deal. If the market were to drop that much next week, how would you restructure your finances? As they say, greed eventually replaces fear, and that's been shown time to time again through every market cycle. Number 2, pay off debt. It should come as no surprise that it's important to keep debt levels low. The problem is that it's easy to become comfortable with your income and expenses to the point where you're not prepared for a crash. After years of earning great money, the mortgage, car payments, and maybe another mortgage in your second home seem like no big deal. If you can pay all those bills while still investing a little money, then what's the problem? The issue is that your expenses are reasonable only based on your current situation. What if your income dries up or you take a large pay cut? Will you still have enough money? The reason rich people weather economic cycles so well is because they live well below their means and only spend a small amount of what they earn. This added security means that even if their income is slashed, they can still go on as usual. Paying off extra debts will allow you to live well below your means like the rich do. Number 1, save cash. Building up cash reserves and having a fully funded emergency account is perhaps the best way to be prepared for all situations. Always have at least 3 to 6 months of living expenses and cash for emergencies. Depending on your strategy, you might decide to save even more cash so you can purchase stocks when they are on sale. The downside to holding cash is that its buying power could be lost to inflation as it sits in a savings account earning little to no interest. At the current inflation rate, your savings will only have about half of its previous buying power within about 15 years. This can be annoying as the market inches higher every month and our expenses are on the rise. Ask yourself, would you rather have 3 to 6 months of living expenses eroded due to inflation, or would you rather run the risk of losing your home because you can't pay the bills? Sometimes people get greedy and forget how much that savings would have helped them in the last recession. Stock market crashes don't happen all the time, but there's something that should be expected as an investor. Don't become greedy and short-sighted, forgetting the possibility of a major downturn. Instead, try to structure your finances as if the market were to crash tomorrow, remembering the mistakes that have been made in previous instances.